that you're here, and I welcome you to this free options trial program that I have created. Now, here's what you're looking for. You're looking for buying and selling stock options or stocks every day, and then usually we close this within 1 to 3 days. So let's say you buy something today, you sell it in the next 2 days, and you collect a profit. And we are looking at collecting about 150 to 250 US dollars per trade, right? And we're looking at about 3 trades a week. So that is how you collect a monthly income of about 1,000 to 1,500, sometimes 2,000 US dollars a month, right? So let me explain to you how this thing works. Let's get started. All right. Now, before we get started, let me explain to you what are stocks, right? So stock is nothing but a commodity. For example, you buy a Facebook stock at $200, and then now you expect Facebook stock to go up. And when it goes up or it goes down, then you make money, right? So yes, you can make money while the stock is falling also. So that's called shorting. So now, these are the technical terms that we use. When you expect the stock to go up and you make money, it's called going long on the stock. And when you expect the stock to go down and you make money, it's called going short on a stock. But this is how the trade actually works. So you buy about 100 shares and they increase $10 in price, and that gives you $1,000 profit, right? Now, the beauty about stocks is that if you buy a stock, you can actually hold the stock for your life, and you can even pass it to your kids, right? After you're gone. So the stock does not have a life, a limitation of time. All right. So if you buy a stock at $100 and then within a week it goes to $50, you have a paper loss of $50, but then you do not have a real loss. So the real loss only happens when you sell the stock. Now, when you buy a stock, you can hold it for 20 years. And as long as you buy a good company like Facebook, like Amazon, like Apple, then these companies do go up in 20 years simply because their business is good, their product is good, customer wants to use their product, and and they make profit, right? So every company that makes profit, the shares will go up. All right. Now, over time, even though I use these names as Facebook and Apple, over time, these companies can go out of fashion. So, for example, if you see the last 10 years, Apple earned a lot of money, a ton of money, right? So, as of today, Apple has about $900 billion in cash as a company, right? But that is because iPhone, as being one product that was sold worldwide, contributed to 70% of Apple's profit margin, right? Now, if you take last 3 months report in 2019, now we are in July, so just the last 3 months, you will see that sales of Apple iPhone have dropped by more than 50%, right? So that means that the iPhone as a product is not generating the profit that it did generate for Apple in the past. All right. And that also means that it may not be the right stock now. So when a right stock, now Apple has other products which are making more profit than the iPhone, but that's not the discussion. The discussion is that when a stock does go down, or if you have had the chance of making money on the stock and this stock goes out of fashion, or the business is not so promising anymore, you can always sell this stock and buy another company which is in fashion, for whom the product is more popular now, right? So that's how you trade stocks. Now, here's the problem with stocks, right? Let me show you the problem with stocks. So let's say we are buying a stock which is $300 in price, yeah, which is like, for example, Netflix or Tesla or Nvidia. These are about $300 right now, yeah. So if you have to buy 100 shares of this, your investment is 30,000 US dollars, and that's big, right? That's huge. So of course, this is not affordable for many people, right? So this is where we say that buying stocks because you want to make a profit. So if the stock goes up by $10-20 and you hold 100 shares, you make $1,000. So your ROI is very little, right? So a $10 growth in the stock gives you $1,000 profit. So if you take $1,000 and you divide this by your $30,000 of investment, you will get your ROI, which is not so great, right? Now, this is the very reason why options were invented and we use options. Now, options give us leverage, all right? So, leverage. Now, let me explain to you what is leverage, yeah? So, keep this calculation and I'll show you what is leverage in a minute. So now what happens with options is the one contract of an option. Sorry, let me write that properly. All right. All right. I just wrote this down so I can easily explain you. So now we were here that I have purchased 100 shares of a company whose stock price is $300, and that brings my investment to 30,000 US dollars. And if the stock goes up by $10, I have 100 shares, so I get $1,000 of profit. And if I take $1,000 multiplied by 100 divided by 30,000, my original investment, my ROI is about 3.33%, right? Which is not a lot. It's not bad, but it's not a lot. Now let's look at options. So in options, if you think the stock is going to go up, you buy a call option. So I draw a arrow. And if you think the stock is going to go down, you buy a put option. So there are two types of options, call and put. And this is what they mean, right? So if you are bullish on option, that means if you think it's going to go up, then you buy a call option on that stock. So let's say this was Netflix stock that we bought, and we think Netflix is going to go up. So I'm going to buy one contract of Netflix stock. And if we think that Netflix stock is going to go down, then we buy a put option. Now, when you buy one option contract, you get 100 shares, right? So the number one advantage of option is that they are very cheap, okay, compared to stocks to invest in. And number two is that you get a huge ROI because the investment is small, right? So let me show you that by an example. So one contract is equal to 100 shares. And now, for example, here we bought 100 shares of 300 each. The cost was 30,000. One option contract on Netflix is going to cost you about $500, for example, right? So you can already see an investment of $500 versus an investment of 30,000. That is a huge difference, right? Now, here is the problem with options. If you say that I'm going to buy a call and then this call is going to make me money if the stock goes up, correct? Options have a time limit. So you can buy option for 1 month, 3 months, 6 months, or 9 months, right? Now what happens is that if you buy an option of, let's say, 45 days, that means you are saying that I'm buying a call option on Netflix, and that means I'm putting a bet on the stock price must go up in the next 45 days. All right, actually much before that. So if the stock price does not go up, it stays where it is, or it goes up a little bit, or it goes down, you lose all the 500 that you invested. So that is the risk with options, right? So whether you buy a call option or a put option, it works in a similar fashion, just that when you buy a put option, you expect the price to go down. So if the price goes up or stays where it is, you lose money. Now, when you buy a call option, then the price should go up. If it goes down or stays where it is, you lose money. All right. So now the question then here is, why buy options? Because the investment required is very small. So let's take the same example. You saw that we actually bought one option contract and that would give us 100 shares. But now the thing is this, when a stock price moves by $1, option price moves by 60 cents. So it's about 60% of the stock price. So if the stock price moves by $5, the option price will move by about $3, 60% of $5, right? So you're getting it. So that means if I get $10 change in the price of stocks, I made $10 into 10 stocks, sorry, $10 into 100 shares, $1,000 just now in stocks, right? Now in options, you will make $6 because it's 60% of the stock price. So stock price moves by $10, then the option price moves by $6. For 100 shares, you will get 600. So that is what I put here. So one contract is 100 shares, and then 60% is the movement. So a $5 movement gives you $3 movement in options, and a $10 movement in stock will give you $6 movement in options. So you get $600 profit for 100 shares over $6 per share. So for 100 shares, $6, 600 over a $500 investment. So your ROI is 83%. Compare that to that of stock. So now I'm going to repeat this whole thing for you just to revise everything, right? And then you get a very clear picture of what's happening. All right. So what we have been discussing is that you can buy shares, stocks, and you can buy options. If you buy shares, you usually the price of the share is high for good companies, so it's about $200, $300, and 100 shares of that company would actually cost a lot of money, right? So for a $300 share, it would cost about $30,000 to buy 100 shares. Now, why do you want to buy 100 shares? Because you want the stock to go up by $10 or $5, and then if you have $100, you make $500, right? If it moves by $5. If it moves by $10, you make $1,000. So the investment is huge, 30,000, and the return is very little, like $1,000, right? So you want another instrument where the investment will be less and the return is higher and the profit is higher, right? So that is where options come in. And now when you expect the stock price to go up, you buy a call option, and then when you expect the stock price to go down, you buy a put option, right? So that is what we write here. So you have calls and then you have puts, right? The second thing we saw is that the price of an option moves approximately 60% of the stock price. Now it can move 80%, 90%, 10%, 20%, but when we buy options, we generally buy those that are at the money, which is about 60%, right? So if your stock moves by $10, your option will move by $6, right? 60%. So that means now if you have 100 shares, you actually make $600 and your investment is very less. So it takes about $500 to buy a call option if you expect the stock to go up, and then because you get 100 shares, because one option is equal to 100 shares, one contract, then you get a profit of $600 for 100 shares, right? On an investment of 500, which is fantastic. Now, the only problem we saw with options is they have a time limit. So 1 month, 2 months, 3 months, and then whatever you put your bet on, whether it's going up or whether it's going down, that must happen within that time limit for you to win. All right. So this is all that. Now let us see live how this looks like. So this is the trading terminal, and I can go to trade. In monitor it will show you the existing positions if you have some. Now you need to understand how to use this think or swim platform, but that's topic for another video. So you can see that I have purchased 100 shares of Microsoft. Okay, at the same time you can see that I have purchased call option on Microsoft 10 contracts, and they are going to expire in the next 3 days, and I purchased them at $10.65, and today the price is 17.4. So that means the profit I have is 17.4 minus 1065. So I'm at a profit of about $6.75, and then that $6.75 is the profit on one contract, which represents 100 shares. So it's $675 on one contract. Since I have 10 contracts, my profit is 6,750. Alright, then when I go to 100 shares of Microsoft, then you see that I bought it at 204, now is 216. So I have a profit of about $12-13, and then that $13 gives me a profit of 1274. Alright, so you can see that the method of buying shares, how it looks in your platform, and then the method of buying a call and how that looks in your platform, and you see that shares do not have an expiry. All right, now if you compare this vis-a-vis, then you can actually see that even if you take just one contract which represents 100 shares, one contract gave you $675, whereas 100 shares gave you 1274 in this case. Okay, but that's not always the case. So you understood now how to buy this. I will type the ticker symbol Microsoft here. This is the option chain. The next video I'll explain you how to look at option chain, and then I'll just right click and buy and say I want to buy a single, and a window will come up which will show me the screen that I need to use for buying the option, and then using that I will actually purchase the option. So I maximized it so you can see easily. So I can buy one contract which represents 100 shares. I need to pay $3.90, and because I am paying this is like $390 is what I pay. Okay, so I pay $390 plus some commission, and that becomes my total cost for the trade. And that's my break-even price. That's the current price, which is 217, plus the price I paid for the option will decide my break-even. So the platform tells me that your break-even is actually at about 219. Okay, so this is how we buy the option, and I can actually show you this. Yeah, you can see that $3.90 is $319, is $390 is your cost, and because you went in. So how to read option pricing we will cover in another video, but this is how you buy an option. All right, that's the important thing I want to show you. And then if you want to buy a stock, you just right click and buy, and you buy 100 shares of the stock. If you confirm, it's going to tell you the amount of capital you need, which is 10,849 to buy 100 shares of Microsoft. All right, so that's where you saw the difference between stocks and options, and you saw how we can actually purchase them. Now let's understand the option chain and then an option pricing in the next lesson.